Imagine the market frenzy of March 2000. The Nasdaq had risen roughly 1,200% in 5 years. Everyone was chasing the next internet giant. But amidst the noise, Warren Buffett ignored the hype. He wasn't buying tech. He was quietly buying a boring business that simply graded other people's debt. While the market collapsed, losing 78% of its value by 2002, Buffett's chosen asset didn't just survive. It became one of the greatest investments of his career. This is the story of Moody's Corporation. How did the Oracle of Omaha turn a $499 million bet into a position worth over $10 billion? The answer lies in identifying a toll bridge economic moat. In the late 90s, the question was, why isn't Buffett buying the future? He was mocked for missing the tech boom. But Buffett saw a reality others ignored. The valuations were detached from earnings. When the bubble burst, panic set in. But in 2000 and 2001, as prices fell, Buffett began accumulating shares in Moody's, which was spinning off from Dun & Bradstreet. The goal was simple. He didn't need to pick which tech company would win. He bought the business that every company needed, regardless of who won. He bought the referee. This brings us to the core of the strategy, the duopoly. Moody's and Standard & Poor's control roughly 80 to 85% of the credit rating market. If a corporation or a government wants to issue debt, to build a factory, fund a war, or launch a product, they need a rating. Without it, investors won't lend them money. Buffett realized that Moody's had pricing power. They could raise their fees, and companies had no choice but to pay. It was a royalty on the global economy. Unlike a factory that needs constant repairs, Moody's required almost no capital to grow. It was pure profit margin. While tech companies were burning cash to acquire customers, Moody's had customers lined up by necessity. From 2000 to the 2010s, the results were staggering. Buffett's initial investment of $499 million multiplied 20-fold. By the time the dust settled on the financial crisis, his stake was worth billions. More impressively, the dividends alone eventually paid back his entire initial cost. He effectively owned a money-printing machine for free. This wasn't luck. It was the discipline to ignore the next big thing in favor of the inevitable thing. The lesson of the Moody's trade is not that you must buy financial stocks. It is that the best investments often look boring when the rest of the world is going crazy. If this story helped you see history in a new way, subscribe to Market Cafe for more true stories, where global events become practical investment lessons for your own life.